So, Prakash, I've been reading about this massive shift in gold flows from London to New York. 393 metric tons of gold? That's, well, a staggering number. What's behind this?
It really is staggering, Margaret. This is one of the largest physical gold movements we've seen in years, driven by the impending 25% tariff on gold imports from Canada and Mexico. With this tariff kicking in next February, the market's scrambling to reposition.
Interesting. But why would this lead to such a dramatic movement?
Well, it's about capturing value. Right now, the premium on gold in New York's COMEX futures market is significantly higher than the London spot prices, around 54.80 per ounce as of late January. This kind of spread incentivizes relocating gold to maximize profits.
Right, so it's a price driven decision. But what does this mean for London? Are they just running out of gold?
Not running out, but they're under pressure. The physical withdrawals are causing delays of 4 to 8 weeks in London vaults, which is unusual. Usually, these processes are more streamlined. What's happening is the demand in New York is distorting the usual flow.
Wait, that kind of wait is almost unheard of, isn't it?
It is. The last time we saw anything close to this was during the pandemic in 2020. But this scale? It's unprecedented. Gold inventories in COMEX have ballooned, jumping from under 20 million ounces to nearly 32 million ounces.
Okay, that's a massive increase in inventory. What about these deliveries? Are people actually cashing in big?
Exactly. Just in the first 2 days of February, delivery requests were 126 tons of gold, worth over $11 billion. It's a fascinating shift in how physical gold is being allocated right now.
And does this reshuffling have any repercussions for global gold supplies, do you think?
It absolutely does. We're seeing disruptions in places like Switzerland, a key gold hub. For example, their exports to the US surged 11-fold in December to about 64.5 tons. That kind of adjustment has ripple effects on liquidity and supply chains worldwide.
It sounds like a domino effect. So just this premium alone is shaking things up across the globe?
Pretty much, yes. The market's adjusting quickly to these tariffs and the spread between prices in New York and London. It's a dynamic situation, and we're likely to see even more shifts in supply flows.
So this shift in gold flows and the resulting disruptions, are they indicative of broader geopolitical undercurrents?
Absolutely, Margaret. When you look at these gold flows, they're like a microcosm of broader geopolitical and economic realignments. For instance, this 25% tariff, it's not just about gold. It's part of a wider trend of rethinking trade relationships and supply chain dependencies.
Ah, like we're seeing countries drawing lines in the sand with trade policies.
Exactly. And in a way, gold becomes both a victim and a signal of these shifts. We've seen scenarios like this during previous economic crises, such as the pandemic, or even way back during financial recessions. What's happening now mirrors those patterns, but on steroids, due to the scale and speed.
Wait, steroids? That's quite the analogy. What's different this time around?
Well, for one, the sheer volume is unprecedented. 393 tons, moving across the Atlantic in a short window. But it's also about how countries are adapting. For example, we're hearing discussions about exporters, Mexico and Canada, say, considering routing their gold to other hubs like Switzerland instead of sending it directly to the US.
Interesting. Wouldn't that kind of rerouting create its own set of headaches?
It definitely would. Logistics become a real challenge. Think about delivery timelines, refining capacity, and customs regulations. All of that adds friction to a system that's optimized for quick, direct supply chains. It'll take time for the market to adjust.
So in a way, these tariffs are shaking up the whole machine. Gold's journey from mines to vaults?
That's right. And it's not just the immediate trade routes. These changes could alter long-term trading patterns, forcing suppliers and buyers to rethink their strategies. We could even see new alliances forming based on how these flows adapt.
It almost sounds like a chess game with some very shiny pieces.
A very high stakes game indeed. And every move, whether it's a new route, a price adjustment, or a policy change, creates ripple effects that take time to stabilize.
All right, Prakash. Thinking about this chess game of shiny pieces, the tariffs, the gold flows, all these global maneuvers, what should investors really be watching for as the next move?
Good question, Margaret. I think there are three key areas investors should focus on. First, the physical gold movements between major markets. These flows often act as a barometer for market stress or opportunity. For instance, if we continue seeing unprecedented shifts, like the one involving London and New York, it could hint at broader changes unfolding.
Right, like a sort of early warning system for market conditions?
Exactly. And second, the price spread between New York and London. If it stays elevated for too long, it suggests the market hasn't adapted yet. And well, that could signal more disruptions ahead, or opportunities, depending on how you look at it.
Opportunities for savvy investors, I suppose?
Absolutely. Which brings me to the third point, understanding how supply chains are adapting to these changes. New trade routes, longer delivery times, and logistics bottlenecks all have real implications for pricing and availability. Staying informed on these moves can provide valuable insight for investment strategies.
Got it. So, watching physical flows, price spreads, and supply chain shifts would be sort of the trifecta for understanding this market.
That's exactly it. And above all, rely on the data. It's tempting to speculate when things get this volatile, but real insight comes from paying attention to actual movements, pricing trends, and delivery patterns. The data tells the real story.
Sound advice, Prakash. It's been fascinating to delve into all of this today. There's so much happening behind the scenes. Any final words for investors tuning in?
I'd just say keep an open mind and stay adaptable. Markets are shifting quickly, but there's also opportunity in this chaos. Look for patterns, understand the broader narrative, and don't lose sight of the fundamentals.
Well, thank you for your insights, Prakash. It's been a real eye-opener. And thank you to our listeners for joining us today on Trade Talks by Deriv. Take care, everyone, and we'll see you next time.